guys, and welcome back to Mike and his whiteboard. My name is Mike, this is my whiteboard, and this is our second installment of Implied Volatility Week, and we're going to look at historical versus implied volatility today and see if there's an edge there for premium sellers. So yesterday we talked about implied volatility and what that means with option pricing. So just to quickly recap, implied volatility is a result of option buying. So implied volatility is not an input into the Black-Scholes model. In fact, option pricing adjusts implied volatility. So when we're looking at historical and implied volatility, there's a few things that we need to know. So let's first define historical volatility. So when we're talking about historical volatility, we're basically looking at a certain time frame and measuring the distance that underlying has moved. So if I have a stock that's at $50 and I realize that over the last 30 days, that stock has moved 10%. So let's say it was at $50 30 days ago, now it's at 45. That would have been a move of 10%. So that would be historical volatility. Now, if I'm going back to the first of that month when the stock price was trading at 50 and I'm looking at implied volatility, let's say I'm looking at a 30-day implied volatility and I saw that the implied volatility stated that the stock had the ability to move 6 or 7%. So with that said, implied volatility would have overstated historical volatility. So that's the main point that I want to get across today, is that in general, implied volatility is going to overstate historical volatility, and we'll get into why that is. So since 1990, IV has overstated IV overstated historical volatility by 83% with all of the days taken into account. Now that's a huge factor. So that's not to say that implied volatility will always overstate historical volatility, but in general, we found that looking back in time, implied volatility has in fact overstated historical volatility. So when we're talking about the difference between historical and implied volatility, a lot of people say that it's a zero-sum game. So what that means is that option prices are perfectly priced. So if we're looking at the efficient pricing model of options, what a lot of people will say is that there's no real arbitrage opportunity anywhere, which is in some cases true. So like we can't take a certain aspect of news that we see on TV and say, wow, I need to trade that right now because I have a certain amount of time before that news is going to be priced into the market. The efficient market hypothesis basically states that everything that's already in the environment in terms of news or anything at all is already priced into the market. The one thing that it does state though is that implied volatility is not perfect, and what we learned yesterday was that we found that implied volatility is mean reverting. So if we find spikes of implied volatility, generally we can expect it to go down. Doesn't mean it's always going to go down right away. It might stay up over a certain period of time, but generally we can expect it to go down. So if our strategy is based around implied volatility and we know that the majority of the time implied volatility is overstated compared to historical volatility, then that would mean that there would be a small edge to option sellers. So let's take a look at this graph here. We've got premium along the y-axis and the strike price along the x-axis. So what I'm trying to show here is we've got historical volatility. So let's say the stock price is right in the middle there, and we've got our normal distribution of implied volatility. So you'll hear on the show a lot of standard deviation talk. So let's assume that this is just a normal distribution of volatility, and the majority of the moves that had happened were right around the stock price, so small moves here and there, up and down, but there were those tail risk events where large moves had occurred. So that's what creates this bell curve. So again, going back to historical volatility. So this is basically stating that the majority of the time, there's going to be small moves, okay? But there's always going to be those tail risk events which are going to create those bars on the outside. So that's why it kind of tails off at the end. But the large majority of the occurrences are going to be within this big bubble here. Now, if we layer on implied volatility, we're going to see that there's a differential here. So with implied volatility overstating historical volatility, there's an edge to premium sellers. So again, let's discuss what this means. So if I've got an option price of $5, let's say I'm selling a put for $5, and the implied volatility is worked into that because, again, with the Black-Scholes pricing model, when option prices go up, implied volatility goes up. And since implied volatility is a forward-looking metric, there's really no way to say whether that's right or wrong. But if we can say that we've looked back to a number of years since 1990 and found that implied volatility has been overstating historical volatility, this differential here is going to be our edge. So let's say I sold this put for $5 and there was that market move that was built into that pricing. Now, let's say the underlying only moved $4 or $3.50. If I'm looking back and find that implied volatility had overstated that, that's going to be an edge to the option seller. Now, again, we discussed earlier that it's not always that way. So 83% of the time it was that way, but that means that 17% of the time it wasn't. So that doesn't mean you're always going to be right if you're a premium seller of options, but if you trade small and often, you're going to outweigh those winners with the losers that you might experience. And that's basically the whole basis of what we do in terms of option premium selling and our volatility strategies. So we're looking for those extremes in volatility so we can take advantage of that, because what we've also found is that the higher the implied volatility is, generally the bigger the differential will be between the implied volatility and the historical volatility. And the guys on the research team has done a great job with this. There's plenty of market measures that look at this. If you just look up historical volatility using the search bar at the top of tastytrade, you'll see the segment that I'm talking about. But it's just great knowledge to know. So whenever we can optimize our trading, that's what we're going to look to do. So again, implied volatility normally overstates historical volatility, but that does not mean that it's always going to happen. And another thing that I'd like to point out is that implied volatility is not an input into the pricing model. The pricing model basically adjusts implied volatility. So there's one thing that's cool about that. In another study that we did, we found that not only was a higher implied volatility level creating a bigger differential between historical volatility, so let's say this implied volatility was even higher, that would mean that the historical volatility may not go much higher than that. So the speculation is what's driving implied volatility, because again, when people are speculating and unsure of what may happen, or if there's a lot of fear in the market, they're going to be buying options to protect their positions, regardless of whether they're long options long stock or short stock. If you're long stock, to fully hedge it, you would buy a put for every 100 shares. If you're short stock, to fully hedge it, you would buy a call for every 100 shares. So that uncertainty is what is creating the option price adjustment, or the option price increase, which therein lies the implied volatility increase. So one last point before we get to our takeaways is that we found that in low volatility environments, we found that there were more up moves than down moves. So the larger up moves occurred in low vol environments than down moves. Now, let's talk about that. That makes perfect sense logically. So if there's not a lot of speculation and people are complacent, if I believe that the majority of the market is long, or people are coming into the market buying stock, that's going to create the stock prices or whatever ETF index, whatever they're purchasing, to go up. So when people buy things, the price goes up. When people sell things, the price goes down. So if not a lot of people are speculating, they're going to be driving up the price, because they're going to be buying and not selling their shares or thinking that anything's going to be going wrong. So generally, in a low IV environment, you'll see the stock market or underlyings trickle up like you have over the past few years. But in high volatility environments, we've shown that there are generally more down moves or more drastic down moves than up moves in a high implied volatility environment. So these are all things that you can use to better your trading. And when you look on a day-to-day basis, comparing like the VIX, which basically tracks the volatility of the E-minis, you can see that when the E-minis are creeping up, usually the VIX is very low. And whenever there's a small spike in the E-minis, the VIX will spike up. So that is the opportunity in terms of volatility selling. And that's why we love to do this at tastytrade, because since 1990, 83% of the time it's worked. So if I'm not putting all my money on the table at once and I'm trading small and often, which means little pieces of my bank account or trading account are going into different portfolio positions, then I can outweigh those losses that might occur and over a lot of occurrences, I can realize that 83% certainty in terms of implied volatility, overstating historical volatility. Now, one thing I want to point out is that just because we've done these research experiments does not mean that it's going to happen in the future. So that is a huge thing to note. But looking back 20 years or so and seeing that that has been a trend, and just the fact that we know that implied volatility tends to have a mean reverting pattern, we can use that to better our trading. So let's get to the takeaways here. So the first takeaway is that option prices affect implied volatility. Again, I'll say this all day long. This whole week is about implied volatility, and I think the biggest misconception is that implied volatility is known and you can put that into a pricing model to determine the option price, when in fact the option prices affect implied volatility. Secondly, IV generally increases when premium is bought. So this makes sense because, like we said, when people are speculating and looking to hedge their positions, whether it's long stock or short stock, or even long futures or short futures, you can use options to hedge against that. So when the general public is buying options to speculate or hedge their positions, that's going to increase the implied volatility. And last but not least, IV is not an input in the pricing model, but can be estimated from it. Again, implied volatility is a result from option price action. So when a lot of people are buying options, implied volatility will be shown to be increasing. And when people are selling options, the implied volatility will go down. So this has been historical versus implied volatility. Hope you guys liked it. Thanks so much for tuning in. If you have any feedback at all, shoot it over to support, or you can tweet us at DoTrade. Tomorrow, we're actually going to be off. Truth or Skepticism will be live, so definitely tune into that. If you want another whiteboard segment to check out July 31st. The actual segment is on the webinar. I sat in with Ryan and we talked about IV rank, so implied volatility rank. It goes along with implied volatility week, so I recommend checking it out. But we will be back on Tuesday, and we'll finish off implied volatility with volatility skew. And that's going to be a great segment, a lot of great visuals like you've seen here. So again, until Tuesday, I'm Mike. Thanks again for tuning in.